Before we move on to our last masterclass and session of the day, I would just like to tell you to please stay back because we're going to announce the lucky draw powered by Fintech at the end of the session. Okay, for the last session of the day, a masterclass on fund accounting. This session will provide a deep dive into the intricacies of fund accounting practices, covering essential concepts, methodologies, and best practices. It's going to be a fitting conclusion to our day filled with learning and insights. Please welcome Mr. Chandrashekhar, co-founder and CEO of Hexagram Fintech. Let's give him a round of applause.
I'm sure all of you have plans for the Friday evening. We went through a day full of sessions. We covered almost all aspects of alternatives and mutual funds, starting with the keynote address, which touched upon the growth of alternatives. We had legal sessions, we had tax sessions. Then we had AML, screening, and what have you. Now it's time for the backroom sessions, the accounting part for all these things. Okay. Before I go ahead with the presentation, I'm going to invite my colleague Shiva to join me here. Come. First, just a brief on how we went about constructing this presentation. We did not want to do a debit-credit session, no journal entries, nothing. But we discovered by going through a few PPMs that alternative funds are getting more and more sophisticated. So certain key concepts should be understood in spirit before we can translate it to an accounting methodology, recognizing that event and what should happen when that event is recognized. So this became the theme of our presentation. So we studied quite a few PPMs and created a synthetic PPM which has a few highlights. So those highlights could be, one, we chose a Cat 2 fund because we found most of the complications in Cat 2 funds. Second, we wanted to select for discussion a fund which has multi-currency classes, which means it could have a class in INR, class in USD, and what have you. Then we wanted to discuss a little bit on hurdle rates, its impact, how does the distribution happen because of the hurdle rates. What happens if an investor comes in later, after the initial closing? How is that investment treated? Or what does he have to do to enter the fund after the initial close? The fund, the PPM also discussed a little bit on the asset side, the kind of debts and equity instruments that it was investing in, and a fair amount of hedging. So we are going to, as I said, we are going to discuss a few points out of this, not all of them. Okay. Certain aspects of the multi-currency class. If you have multi-currency classes, what could be the implications? What happens when an investor comes in late? There is a treatment called equalization. He has to be made equal as though he came during the initial closing. So what is the process to be followed when there is a need for applying equalization? Then there is a concept called excuses and exclusions. So certain investors may not want to invest in certain types of assets because of personal reasons, because of the governance reasons, whatever it is, but this is disclosed upfront. In the agreement he signs with the manager, he discloses that if you're going to invest, for example, in the tobacco sector, I may not wish to participate in that. Or he may be a ESG conscious investor who may bring in some other concepts of his own and say, if there are going to be investments in these kind of sectors, I may not wish to participate. Right? So how do you treat that? What should we do if there are exclusions? Then finally, a little bit about the waterfall. How is the distribution itself affected in these kind of structures? What does it mean? How does the money flow? Whenever there is a realization of income, realization when there is an asset that is disposed or sold, how are the proceeds going to be distributed among all the investors? So this is what the final topic will be. So the fund structure is normal. You're on the capital side, you may have multiple currency classes. you'll have domestic INR investors coming in. Normally the foreign USD investors or foreign currency investors generally come in through feeder funds which are located in tax domiciles. On the asset side, you would have INR denominated assets as well as you could have foreign currency denominated assets. If the fund is doing a fair amount of hedging, you may have some off-balance sheet accounts. This would broadly cover everything that the scope of the fund in terms of its structure. This is what it would cover. Now, we will go into what happens in a multi-currency situation. What are the possible complications? What is the impact of running a fund with two classes, each having its own currencies, right? Shiva, would you?
Yeah, sure.
Okay. Go ahead.
Okay. So, so the setup is that it's a multi-currency fund, and when we say multi-currency fund, we are talking about the issuance side. So, units in say USD and INR. The first implication that plays out really is the fact that you could have the exchange rate move during the life of the fund. If you have a CAT2 closed-ended fund with say a commitment period of say 3 years, which is how we have constructed the case study, you start the journey with a foreign currency unit holder making a certain commitment, and the drawdown, meaning the actual deployment of the funds could happen at a later date. And in the interim, you could have the exchange rate move substantially. And just to illustrate this point, whilst USD INR has a certain element of, for the lack of a better word, predictability and stability to it, to illustrate this point, we asked ourselves what would have happened if Japanese yen units had been issued, say 3 years ago by a CAT2 fund in India. We know that Japanese yen has gone through its own story in the last 3 years. It has weakened substantially. And what we concluded was that, and this is on the right-hand side of the graph, you can see that INR JPY has moved from 1.5 to 1.89, and what the implication of that, as we will see in the next slide, is that there would have been a material impact on the actual size of the fund, as also a few other implications, which we will get into. Now, this is, before we move to the next slide, this is not entirely hypothetical. Interest in India is naturally rising, and that is an interest that is shared by Japanese investors as well. And if they continue to remain active investors globally, and if other markets are anything to go by, Japanese interest in Indian assets, not only will it grow in quantum, but one could expect that it will also grow in terms of complexity. They could start getting interested in debt funds, etc., as they have been in European and US markets. So if we move to the next slide, just to illustrate, now this is a fairly simple numerical illustration which we can walk through fairly quickly. The first, the picture on the top, it shows what would have happened to the size of your fund had you invested, had you issued units in INR as well as USD. We are considering a fairly simple fund where the expected fund size is about 266 crores. Now, the point we are making is that let's assume that your exchange rate was 83 when the fund started its journey. Let's assume a 3-year commitment period, and let's assume that in the interim, the USD INR exchange rate moves to 88. What you would have seen is a modest increase in the final fund size, which going from 266 to 276, and this is purely because the committed USD amount translates into a higher INR amount due to the exchange rate moving. Similarly, the picture at the bottom, the story goes the other way. Now, we've taken Japanese yen here. And in fact, these numbers are real. So if you go from one, they are not hypothetical. If the INR JPY conversion rate, if it has gone from 1.5 to 1.89, and during this time, if a hypothetical CAT2 fund, its size would have gone from 300 crores to about 260 crores, which is a substantially smaller eventual fund size due to exchange rate movements. So that is a big headline. We are saying that the size of the fund comes down. You go one level deeper, and that's where some of the more challenging bits, operational bits, begin to emerge. The first bit that comes up is the question of in what ratio are you going to draw down across your INR and INR and foreign currency units, and what do we mean by that? There is a certain commitment that has been made by your rupee investors on day one. There is a certain commitment that has been made by your foreign currency unit holders on day one. And this is a number. So you could have, for example, 50 million US dollars and 100 crores, just to illustrate. Now that is the number that has been agreed on day one. Subsequently, after when the fund has identified a particular investment opportunity, which could happen after months or even years, the fund manager issues a drawdown notice. In other words, that's when you call the money in. And due to exchange rate fluctuations, the question you ask yourself is this. Normally, if it was a single currency issuance structure, it's simple. You say, let me call 20% of, let me issue a drawdown notice which calls 20% of the committed capital. Now, when you have units across different currencies, if you go and apply a 20% number across all the drawdown notices, you will end up with, when it's translated into INR, you'll not only get variations, you'll find that in INR terms you're drawing down different numbers, different percentages across across different unit holders, and that would have implications in terms of how much of the asset each unit holder invests in. There'll be a variance in terms of the ratio when you go from the initial committed amount to what eventually gets translated in terms of the asset allocation. The other way to do it is to say that I'm not going to worry so much about the percentage that I'm going to print on my drawdown notice. I'm going to look at what the initial commitment was. Let's say 50% from INR unit holders, 50% from USD unit holders. What I'm going to do is I'm going to stick to that ratio when it comes to what actually gets invested. So if I'm going to invest in a 50 crore INR asset, I'm going to draw 25 crores from INR unit holders and 25 crores from USD unit holders. The implication there will be that in the drawdown notice, you will probably have different percentages of the committed amount that you will end up calling. So that's, and this is operationally something that needs to be sorted out by the fund managers and and in the next slide, what we'll just illustrate this with fairly simple numbers, which we'll run through fairly quickly. So same story as I just said. The numbers of interest are in the last column, where you can see that in the first table you started out with a 50% commitment across two different currencies. In terms of contribution percentage to the investment based on the exchange rate at drawdown, you see that the 50-50 did not hold. It ended up being 47 and 53 because of exchange rate movements. Here, clearly you stuck to the same drawdown percentage when you called the money from your LPs. The second picture, in the second table is the second story, where you say, I'm going to stick to 50-50 when I actually invest. And as you can see in the last column, what that meant was you're going to call 50% of the committed amount from INR unit holders, but only 44% from your USD unit holders. That's the summary of the story. The next challenge that comes is when it comes to hurdle rate. Hurdle rate is a certain minimum return that I, as a fund manager, has to make before I can start charging a performance fee. Okay. Now, it's quite common to apply different hurdle rates across different unit holders across currencies. So just to illustrate, for example, you might apply a 10%. This is actually a screen cap from a PPM. So you can see that 10% has been applied for INR unit holders, whereas only a 7% hurdle rate has been applied for USD unit holders. And this could lead to interesting situations. For example, one of the situations could be that in INR terms, you might actually clear the hurdle, but in USD terms, you might not clear the hurdle. So why does that happen? Very quickly running through the numbers, you've got 20 million US dollars contributed and 160 million INR, 160 crores of Indian rupees contributed. This assumes an exchange rate of 80 at inception. Now let's assume that the exchange rate moves to 93 by the time you get out of this particular investment. Let's assume you realize 520, you started the story with 320 crores. Let's assume the exit was 520 crores. Now, out of this 520 crores, 260 crores goes to the INR investor, no problem with that. Half of it goes to the INR investor. But the remaining 260 crores that goes to the USD investor, if you apply an exchange rate of 93, works out to approximately $28 million, which is what you see in the table on the bottom right. $28 million on an investment of $20 million works out to an XIRR of 6.92 for 5 years, which is what we used in this illustration. Whereas if you look at the picture on the bottom left, in INR terms, the hurdle is 10.1, the XIRR is 10.19%, which is over the hurdle rate of 10%. Now, it was the same asset, it was the same ratio in which the proceeds were distributed. In one case, the hurdle rate was achieved. In the other case, the hurdle rate was not achieved purely because of exchange rate fluctuations. And this gives rise to its own set of complications. Do I charge performance fee? Do I not charge performance fee? What happens? So those are the kind of complications that arise. In terms of just for some context, single currency structures where you issue, say, USD units and translate it into INR investments. It's a fast growing space in India. Multi-currency share classes are not quite yet common in India. We've not seen too many attempts being made to issue multi-currency funds. Just for context, in globally though, there are quite a few. Just to illustrate, there is Apex, which is on to its 11th fund. It's a dual currency fund. It issues in USD and euros. It also invests in USD and euros. That is just something that we've included for illustrative purposes. And it's a fairly large fund, as you can see. The last one was across the 11 funds that they have raised so far, the AUM is approximately 77 billion.
So we'll move on to the next topic, which we want to touch upon, which is equalization. Equalization is necessary, as I said at the beginning, when additional investors come into the fund after the initial closing or after a certain closing has happened. This is to ensure that the new investor or the additional investor who has come in is treated as though he participated in the fund during the initial closing itself. It gets complicated if there have been drawdowns between the initial closing and the time when the new investor comes up, because during the initial closing there are already other investors in the fund who have already parted with their money, whereas the new investor is going to invest only during the current closing. So there's a concept called equalization interest which gets applied when an investor comes in later into the fund. As I said, from a FA perspective, it is important to understand this concept. Typically, funds keep the equalization interest rate equal to the hurdle rate because that's a minimum the fund has to return to the investors. So it's quite logical to say equalization interest, like in the case that Shiva explained, we had a 10% hurdle on INR investors and a 7% hurdle on US investors. So if a INR investor is coming after the initial closing, in addition to matching the commitment ratio, supposing the earlier investors, basis their commitment amount, had already given 20% as their drawdown. So this investor also has to commit and give 20% of that as a drawdown, number one. Number two, he has to pay an interest on the drawdown amount equivalent to the hurdle rate. In our case, it was 10%. This would be laid down in the PPM or the agreement that the investor signs with the manager. Sometimes what happens is, I mean, this is a very simplistic case. Now, the equalization interest does not belong to the fund. That is paid to the original investors who have already given the drawdown. So the fund will only collect it and pass it on to the existing investors. Supposing that 10%, there's a numerical example, we'll go through that. So whoever comes in later has to pay this because he's coming in late, whereas the other person has already put in his money. So 10% of the money he brings in will go back to the original investors. It does not belong to the fund. Theoretically, because the other person has already financed acquisition of an asset, the distribution of which will be enjoyed by the new investor also, because he is going to be treated as though he brought the money during the initial closing itself. So that's why you need to charge the equalization interest. Sometimes what happens, if the fund is keeping the percentage of the commitment to the drawdown, it wants to maintain in a certain manner. So assume there was an original total commitment of say 500 crores. Committed by 5 investors, 100 crores each. Now when they do that, that means each of them has contributed 20% each. Now there is a new investor or a few more investors who are committing to 500 crores. Now the total commitment has become 1000 crores. So the amount of drawdown that each person has paid earlier becomes only 10%. Correct? So when you true that down, sometimes the additional investment brought by the new investor goes back to the original investors to compensate them for the reduction in the investments that they had already paid. This is also quite common. But general thing is, if there are new investments coming up on, if there are new investments planned, then only the equalization interest is charged. You don't need to redistribute the capital, because the capital will become 10% for the original investors, 20% for this guy. So I have to compensate for the reduction in the capital. There will be a reallocation of capital sometimes, not necessarily always. Okay? We are trying to put down a very, is that, oh, this is a continuous. This is the same thing. So the new investors are required to contribute in order to match the drawdown percentage. In our example, we said 20% of the commitment was already paid by the original investors. So the new investors also have to cough in 20% of their commitment as the drawdown. And there is a equalization interest. Just to give a very simple example, there was a, can you explain this?
Yeah.
Yeah.
Sorry.
Okay, let me do that. There was a, yeah, go ahead.
So here, we just, for illustration purposes, this story runs only for 1 year. We start in 2023 and go to 2024. Let's assume that in 2023, your first, you had the initial close, and for illustration, we'll assume $12.5 million US came in, 100 crores of INR commitment came in. This is the commitment that has, the first row tells you about the commitment that has been made. The second row tells you that in 2023, a drawdown of 20%, a drawdown notice went out for 20%. So which means that $2.5 million US came and 20 crores of Indian rupees came. Come 2024, which is the third row, a new investor pops up. And the new investor has, as we said in the earlier slide, there are a couple of things that need to happen. Firstly, the new investor makes a commitment of 100 crores to begin with. The new investor has to, firstly, in terms of the drawdown percentage, he has to come on par with the existing investors. So that's 20%, which translates to 20 crores, which is what you see highlighted in the third row to begin with. So that 20 crores, firstly, brings the new investor up to the same level of drawdown as the existing investors. That is the first part. The second part, as we explained earlier, is that there is also an equalization interest component because the new investor has come in 1 year late. In this case, we have assumed that the equalization interest, the hurdle rate is 10%. So if you apply a hurdle rate of 10% per annum on the drawn down amount, that comes to 2 crores. So your total for the new investor, the total money that the new investor has to pay up on day one for a commitment of 100 crores comes to 22 crores. That's 20 plus 22, 20 plus 2, 22, which the 2 crores goes back to your existing investors.
Yeah, the 2 crores has no impact on the fund. It will go back to the original investors. So as mentioned, sometimes what happens is certain investors do not want to participate in a particular investment made by the manager. If the PPM or the agreement you have signed with the manager permits that, then it is important that we maintain the investor contribution percentages at the individual asset level, because distributions, if any, from the asset where a particular investor has been excluded should not go to him. So there is a need to maintain, that's the important part with excuses and exclusions. It's important to remember that there are certain assets which will not be, the proceeds of which will not be distributed to all investors based on whatever logic that we apply. If an investor has opted to exclude himself from that, he should not get any proceeds. So it's important to bear that in mind. Next, we'll discuss a simple waterfall. So whenever distributions are made, in this particular case study that we have taken, we have said it supports, initially it supports to make sure that all the capital paid in by the investors are repaid because of the distribution. So whatever, it supports a model called whole of funds method, which means you're looking at the entire proceeds of the fund and you're distributing as and when funds are available for distribution at the discretion of the manager, of course, and as per the agreement. It may say as soon as the proceeds are received, within a certain number of days, I'll effect the distribution, or I'll deduct any management fee payable from me and then give the balance of that. There could be multiple clauses which determine when and how much he has to distribute. But a simple waterfall would be, first priority is to pay back the investors whatever they have contributed, which means you're going to pay back the capital. After that, you will keep paying back to the general partners or the limited partners or the investors to ensure that you satisfy the hurdle rate. So the hurdle rate, let's remember, is calculated on a XIRR method, which means the date of the cash flow becomes important and you need to arrive at the IRR rate and make sure you have given enough to satisfy that hurdle that we have committed. After satisfying the hurdle, whatever remains is split 80-20. This is the generally accepted thing, but it could depend on the agreement, 80-20, 75-25, whatever, or 85-15, whatever the case may be. The remaining proceeds, which is the pure profit, is distributed on a certain ratio which is previously agreed, which is generally 80-20. Now the complication here is, sometimes when they say you will pay with catch-up, which means though you are committed to pay 10% hurdle, even on the no payment will go to the general partner, to the manager, till he satisfies the hurdle rate. But once he has satisfied the hurdle rate, anything above the contribution that he has paid back to the investor should be split 80-20. The triggering of the money flow to the manager happens after the hurdle is reached. But the ratio of 80-20 will apply on every dollar that is earned beyond the capital returned to the regular investors. Okay? So that is the concept of what they call catch-up. Which if they say with catch-up, that means anything above the contribution made by the investor is split 80-20. If it is without catch-up, 10% hurdle belongs to the investor. There is no share of any share for the general partner from that. Anything above that is shared 80-20. Okay. So, yeah, it's a pretty simple, how do you put it, mathematical formula to be applied for that. But what needs to be noted down is even the waterfall, the method of the waterfall, everything is documented in the agreement. So, as fund accountants, we need to first of all understand the agreement completely and then effect the distributions, or say this is how the distribution will happen, obtain the approval of the general partner or whoever is the approving authority before the distribution is effected. You want to cover the numerical part?
Yeah, sure. So as we said, the arithmetic is fairly simple. There's probably just a couple of things to highlight here. One is, yes, the language of the waterfall is probably the bit that requires very close scrutiny and study by a fund accountant so that we understand what is being said. And just to illustrate that point, for example, so here, this is a fairly simple case. Original sum invested is 10%, your hurdle rate is 10%. Original sum invested is 100 rupees, hurdle rate is 10%. Let's assume that the exit after 1 year is 150. Okay, fairly simple case. Step 1, from the proceeds of an exit, repay firstly your 100 back to the investor, which is the money he originally invested, and the 10 rupees to, which is the hurdle rate. So your step 1 basically repays 110 to the investor. No questions there, because that's how the waterfall is constructed. The second bit is where it gets slightly interesting, and just to bring out a nuance, I'm just going to spend 30 seconds on this. In the catch-up, it says that after step 2, at the conclusion of step 2, what should have happened is that 80% of the returns should have gone to the investor, 20% should have gone to your fund manager, which basically means, let's assume X is what has to be paid to your fund manager. And I draw your attention to this particular bit here where it says 0.8, which is 80%, multiplied by the total return that you're distributing, which is 10 plus X, should equal 10, because 10 is what has been paid to the investors so far. And that basically solves for X. It's a fairly simple idea, but just drawing your attention because, more to illustrate that the language can be quite detailed. And that tells you that, straight away tells you that 2.5 is what has to be paid to the fund manager. And then step 3, so far until step 2, you have distributed 110 in step 1, 2.5 has been distributed in step 2, so 112.5 has been distributed until the end of step 2, which means that we said 150 is the total proceeds of the redemption. So you have 37.5 left. 150 minus 112 is 37.5. That follows simple 80-20 sort of split. You'll distribute the remaining 37.5 in the ratio of 80 to 20.
Great. Thanks, Shiva. This also maybe.
Yeah. So moving on, this is again this is an area of interest and something that we wanted to talk about, which is how technology can help do a better job of digesting the various qualitative or quantitative aspects of a term sheet or a particular asset, and so on. So if you see both across equity and debt, you will find there are, to illustrate this point, if you take equity or debt assets, you often find clauses in the asset which are protective of the investors. So two examples: if you take equity investments, in certain cases you have what is known as liquidation preference. Liquidation preference meaning, if I've simple story, if let's say I've invested $20 into a particular venture, and I've got a 20% stake in that venture. Okay, liquidation preference basically works this way. If, say, 2 years later the venture is sold, let's say it's sold only for 40 rupees. Liquidation preference says that although I own only 20% of the venture, I have a first right over, say, 20 rupees, so that I get my money back. My ownership, my stake in the venture takes a step back. The liquidation preference clause takes precedence, and I recover my 20 rupees first, which is the capital that I had invested. So, it's known as liquidation preference. Sometimes it's 1x. In some really extreme cases, it goes up to 4x, which means that the investor says, for every $1 that I invested, I first will take back $4 before anyone else gets to see their returns from the venture. In these kind of situations, the point we are making is, how can technology help administer? How can a system digest some of these qualitative factors? And for example, to give you a simple example, it could be a case where a trigger could be raised on a particular date to ensure that a covenant is not missed. That's what we are saying in this particular slide.
No, it's an extension of a service that because fund accountants have to digest the PPMs and the agreements. They have to apply various clauses of this as a matter of routine when they're delivering asset servicing, asset services. This could also be an add-on service that they can provide. In terms of what could be the unique, I don't even want to use the word unique, the major features that a automated system should provide for us to operate effectively as fund accountants. Okay. The first and foremost thing is for the ability to understand somehow the various agreements, the contribution agreement, the PPMs, etc., and develop an intuitive environment internally which can check, like there is money to be distributed, then if it has understood the PPMs and the contribution agreement, then it should know it's a distribution with catch-up, hurdle is so and so, I have to compute it in this method, and it should be able to understand this and at least alert the user in terms of what could happen tomorrow when there is a distributable surplus. Then obviously, if there are multiple currency classes, it should be able to manage the translations, the revaluations, and whatever else that we discussed as peculiarities of multi-currency classes in a fund structure. Expenses are a huge topic on its own. There are various ways in which expenses have to be allocated. Again, this comes from digesting the PPMs or the contribution agreements. The system has to be able to understand that and apply it properly so that expenses are allocated appropriately. Support for the waterfall model, the distribution model that the PPM indicates. This could be, as I said, the example we spoke about was a whole of funds model. You could also have a deal by deal model where every asset, when it gets liquidated, it could have its own hurdle, its own way of distribution. Or rather, distribution is triggered for every asset's liquidation, right? Whenever an asset generates revenue, it gets distributed separately. That could mean the manager sees money earlier. When there is a deal by deal situation, the manager or the person who gets a carried interest may see money earlier. Then that was about the equalization. We discussed that. That's an important concept. Again, understanding everything stems from the ability of the platform to understand the contribution agreements and the PPMs. The various clauses should get digested by the technology platform so that it can provide optimal automation support to whoever is using the platform to deliver this service in order to scale, also for it to be more accurate and robust. So I'm not touching upon any other aspects of automation here. I'm not talking about reporting capability or anything. The heart of the system should be driven by its ability to interpret the various agreements, the various clauses, be it waterfall or how do you compute the hurdle rate. We thought XIRR is only one method. There are multiple methods. There is investment multiple as a method. So you could have multiple methods in everything, correct? Like throughout the day, everybody has said alternates are bespoke. They are not standard. So even though they are bespoke, in my opinion, there are finite ways in which certain clauses operate. At least to that extent, we should be looking at platforms which can provide very, very optimal support to deliver this critical service. Yeah? Thanks a ton. I've held you back quite enough, I think, for a Friday evening. Thanks a ton.
Thank you, Mr. Chandrashekhar, and thank you, Mr. Shiva, for wrapping up our day with those advanced fund accounting concepts. And thank you to everyone who participated in today's masterclasses. We trust that you found the session insightful and gained, knowledge on complexities of fund administration. All right, before we conclude the event, can I please have Mr. Senthil on stage to, say a few words and also announce the winner of the lucky draw. Thank you.
Thanks. Thanks all of you. It's been a splendid evening today. So we had varied sessions across fund accounting, AML, private market panel, public market panel, and it's been quite interesting for us to learn on a day-to-day basis. And I would like to thank Equalifi for wonderful support over the last 1 month in terms of organizing this event. And we look forward for many such events. And thanks for all of you for staying throughout the day. Thanks one and all. And now the most awaited, the lucky draw. Some clues. Phone number starts with 9. How many of you? Okay, just a clue. How many of you have the name starting with P? Please stand up. Okay. Ending with I. How many of you are there? Okay. So without any more delay, it is Pratik Kotari from Northern Arc. So thank you all. Aditya, you want to say? Yeah.
No, so thank you so much. My thanks to the KFin team. They've been great support throughout planning this, and it's not just one event. We do so much more. So thank you all for making it to today's event. If you are new to Equalify, go and check out the website. We are a very first of its kind membership community for BFSI sector, and idea is to do anything and everything that helps the industry grow. So if you're not a part of Equalify yet, we invite you to become a member, you and your organizations, and continue to support the development of BFSI. On that note, thank you, and look forward to see you next year. Good day.